and welcome. In today's recording, I want to give you a brief economic update as well as talk to you about what transpired in markets predominantly during the second quarter of 2022 and also how this has translated into the investment delivery of our multi-asset momentum focused fund of funds. I will unpack the performance briefly and close out with our fund positioning as well as our outlook for the near future. Now, inflation. This is of course the hot topic on everybody's lips at the moment. The Russian invasion of Ukraine, together with aggressive lockdowns in China, have reignited some of the supply chain disruptions, and this has further lifted the already high inflation projections. Since the end of the second quarter, we also saw inflation surprises to the upside in the US, and even in our local economy. And this has pushed central banks to hike rates even more aggressively than market expectations. Now, this aggressive tightening, coupled with accelerated unwinding of the very accommodative monetary policies or quantitative easing post-COVID, has ignited fears of a global recession. While a policy-induced slowdown in the global economy is very likely, we see the chances of stagflation, which is of course a combination of high inflation and low economic growth, as being slightly more muted. Fighting inflation is likely to remain the primary focus of central banks, however, until inflation reverses downwards. During this period, the fundamental backdrop for both global equities and bonds should remain relatively poor. However, once the inflation trend has clearly reversed, the fundamentals for bonds should improve, while equity fundamentals are likely to stay weak until sufficient clarity is found about the extent of the growth slowdown. Now, given this prevailing economic environment, it was of course a very brutal quarter for almost all asset classes across the board. Following on from a very volatile May, the month of June saw the most significant drawdowns. Global developed market equities contracted by 16.6% in US dollar for the quarter, very much in line with the S&P 500 at minus 16.5%. The tech-sensitive Nasdaq struggled with minus 22.3%, while emerging market equities fared slightly better with minus 12.4%, as China embarks on a slightly looser fiscal and monetary policy in contrast to the West. By comparison, South African asset classes performed better than their global counterparts, but the risk-off sentiment eventually prevailed, and local equities sold off by 10.6% during the quarter. Resources were hardest hit with 20.7%, followed by financials with 15.8% and industrial selling off by 3%. The industrial supersector benefited from a significant re-rating in Naspers process over the quarter. Listed property, on the other hand, sold off by 10.3%, and nominal bonds were not spared, selling off by 3.7%. Inflation-linked bonds and cash were the only positive asset classes with 3% and 1.2% respectively. Now, the rand has been strong in relation to other emerging market currencies throughout the early part of the year, but eventually the flight to safety prevailed during the second quarter, and this saw the rand depreciate by 11.4% for the 3-month period. However, this is largely because of a strong dollar, which has been gaining ground against almost all major currencies of late. The depreciating rand softened the blow in local currency terms for dismal global asset class returns over the quarter for local investors. Turning our attention to multi-asset class funds now, in what has been one of the worst first halves of the years for markets in over 40 years, the momentum-focused fund of fund range also entered the quarter in negative territory. But through the diversified nature of the funds, they also managed to protect investors from the sharp drawdowns in broad markets. The one-year returns remain in positive territory, but they have moderated somewhat from the high double-digit returns posted in recent periods. The funds all performed credibly, either in line or outperforming their strategic benchmarks, and they do remain competitive looking further out from the strong negative quarter. With so much volatility abound, no major positional changes were undertaken during the second quarter, and our focus is shifting beyond the immediate short-term market impact. We have persisted with marginal overweight tilts to local equity, and this has moderated somewhat with the market pullback. We do have sizable overweight positions to local flexible bonds, just given the strong outlook for these asset classes on a relative basis. Other marginal overweight positions include global equity and global property, both which have also moderated organically given the sell-off. Local cash and property remain at underweight positions. Of course, given the multitude of risks abound, a cautionary approach is currently warranted. And looking further ahead, we do remain somewhat defensive in our approach. Considering the recent rand depreciation, as well as our outlook of fair value for the currency, we have added some protection to the global component of the funds, and this will allow us to participate in further depreciation while simultaneously also protecting us in the event of a strong re-rating in the currency. The local equity market is trading at a strong discount to historical averages, and our local bonds remain very attractive in the global arena, especially now given the additional sell-off we've had during the second quarter. Should inflation be brought back in line, we will look to these assets with new optimism, but for the moment we do retain our tactical tilts. We are also positioned very close to our long-term strategic exposures. That's all from me for today, and thank you for listening.